Welcome back to the deep dive. Today, we are going to do something a little different. Usually, we are up in the clouds talking about strategy, asset allocation, or market trends. But today we are going into the basement. We are looking at the plumbing.
The plumbing, that is an evocative way to start.
It's accurate, though, isn't it? Everyone wants to talk about the stock picking, the glamour of the trade, finding the next multi-bagger. But nobody talks about the operational pipes that keep the financial system from flooding. And that is exactly what Chapter 17 of the NISM series XA curriculum is about, operational aspects of investment management.
You are absolutely right. If investment management were a high-performance sports car, the stock picking is the paint job and the leather seats. Operations, that's the transmission, the fuel lines, the engine block. It's unsexy, it's dense, and if it breaks, the car doesn't move.
And that's the mission today. I've looked at the source material, and I'll be honest, it's a wall of text. It's full of acronyms like ASBA, CKYCR, FCNR, and PIS. It feels like alphabet soup. But for anyone taking the NISM exam, or honestly, for anyone who wants to actually understand how their money moves, this is the most critical chapter.
I would argue it's the chapter where you lose the most marks if you aren't paying attention. The concepts here aren't abstract theories, they are hard rules. Specific numbers, specific dates, specific limits. You can't bluff your way through a question about NRI tax status. You either know the day count or you don't.
So our goal is to replace the need for the listener to read that dry PDF. We are going to break this down chronologically. We'll start with who is allowed to play the game, the investors. Then we'll look at how they get through the door with KYC. We'll talk about how they hold their assets in demat. We will spend a good chunk of time on the special cases, NRIs, and minors, because that seems to be where the complexity spikes. And finally, we'll look at how money actually changes hands.
That is a solid roadmap. It's the life cycle of an investor, effectively. From birth opening the account to the day-to-day maintenance and eventually to transmission, which is what happens when the investor passes away.
Let's start at the beginning then. Section 17.1, investors and the investing process. It seems like a simple question, but in the eyes of the regulator, who can invest is a loaded inquiry.
It is. Broadly, the market divides the world into two massive camps. You have the individual investors and you have the institutional investors.
Okay, let's break down the individuals first. That's probably most of us listening.
Right. But even individual is a bucket that holds several distinct legal entities. First, you have your resident individuals, citizens living in India. That's the most common type.
Simple enough.
Then you have minors, who are people under the age of 18. They can invest, but there are special rules we'll get into.
Through a guardian, I assume?
Exactly. Then you have the Hindu undivided family, or HUF, which is a unique tax entity in India, treated as a separate person in the eyes of the law.
And then the folks who are not in the country.
Correct. You have the non-resident Indians, NRIs, and persons of Indian origin, PIOs. And finally, you have a category called foreign portfolio investors, or FPIs, who can also be individuals registered overseas. So it's not just one type of person.
And generally speaking, when we look at this whole group of individuals, what's their defining characteristic from an operational point of view?
It really boils down to ticket size. Individuals usually have a smaller ticket size, meaning the amount of money per transaction is lower compared to, say, a bank or a mutual fund.
So we're investing thousands, they're investing crores?
Precisely. And individuals are geographically dispersed. They are everywhere. Mumbai, Delhi, small villages, tier 2 cities, they're spread out all over the country.
Okay, let's contrast that with the other camp, the institutional investors. These are the whales.
Exactly. We are talking about companies, corporate bodies, trusts, charitable societies, banks, pension funds, insurance companies. The list goes on. The sheer volume of capital they move is massive. But here's the critical distinction for the exam and for operations.
Okay.
An individual can act on impulse. You wake up, you read some news, you like a stock, you buy it.
Impulse shopping for shares, I think we've all been there.
Essentially, yes. An institution cannot do that. They are bound by a charter, a trust deed, or a set of statutes. Investing has to be a formally permitted activity for them.
What does that mean in practice?
It means they need a board resolution. They need an investment committee to formally approve the decision. They can't just have the CEO wake up and decide to buy 1 million shares of something. And operationally, they can't just sign a form. They have a list of authorized signatories.
So if I'm a mutual fund distributor and a local charity wants to invest their surplus cash, I can't just take a check from the treasurer and call it a day.
Absolutely not. No. You need to see their trust deed. You need to get a copy of the board resolution authorizing that specific investment or type of investment. You need the list of people who are actually authorized to sign on behalf of the trust. It's a much heavier compliance lift.
That makes sense. It's about protecting the institution's money from rogue decisions.
It's all about governance.
Now, there is a term in the text that seems to bridge these two worlds. Accredited investors. This sounds like a VIP club.
It essentially is. This is a concept SEBI introduced to acknowledge that not all individuals are the same. If you have a high net worth or a very high income, your ability to understand and absorb risk is assumed to be higher than the average person.
So if I have enough money, I get a special badge.
You get a certificate of accreditation from an accreditation agency, and the benefit is access. Accredited investors can invest in complex, high-risk products that are off-limits to the general retail public, things like certain hedge funds or private equity deals.
And the logic there is what?
The regulator assumes that if you are accredited, you don't need as much hand-holding or protection. You're considered sophisticated enough to know the risks you are taking.
Okay, and just to cover our bases on who is eligible, the text mentions a specific list in the offer documents. It's not a free-for-all.
Yes. This is a key operational check. You always have to check the offer document for the specific scheme or issue. It will explicitly list who can invest: resident individuals, PIOs, partnership firms, scientific research organizations, and so on. If you aren't on that list, you can't buy the ticket. Simple as that.
Okay, so we know who the players are, but before they can place a single trade, they have to get onboarded. Section 17.1.2.
The client onboarding process. This is the gatekeeper, and the password to get through the gate is KYC, know your customer.
We'll dive deep into the mechanics of KYC in a bit, but this section mentions something very specific about public issues and timelines. This feels like an exam trap waiting to happen.
It absolutely is. When a company launches a public issue, like an IPO, it isn't open indefinitely. The company notifies a specific period. There's an opening date and an earliest closing date. But the operational revolution here is how you pay for it.
This is ASBA, right? Application supported by blocked amount.
Yes. ASBA.
I remember the days before this. You would write a check for the IPO. The money would leave your account. You'd wait weeks. If you didn't get the shares, you'd wait for a refund check in the mail. It was agonizing.
It was inefficient, slow, and prone to fraud. ASBA completely changed the game. The rule, and you should flag this, effective since January 1st, 2016, remember that year, is that for any application in a public issue, ASBA is mandatory.
How does that actually work under the hood? What does blocked amount really mean?
It's exactly what it says. You submit the application through your bank or broker. The money stays in your bank account. It effectively gets a lien or a freeze marker on it. You can't spend it, but it's still sitting there earning interest for you.
Okay, so it's ring-fenced.
Perfectly put. It's ring-fenced. It only leaves your account if and when the shares are actually allotted to you, and only the amount for the allotted shares is debited. The rest of the block is released immediately. No more waiting for refund checks.
That is so much cleaner. And the text mentions UPI is now part of this ecosystem.
Yes, for retail investors, SEBI has integrated the Unified Payment Interface, UPI, with ASBA. So you can authorize that block right from your phone with a UPI PN. It's made the process incredibly seamless.
Okay, moving to section 17.1.3, terms of offer. This sounds like the legal jargon for read the fine print.
It is, but the fine print contains eligibility criteria that can trip you up. The terms of offer is the document that defines the boundaries of the product. It tells you who can invest, how much, and under what conditions.
Can you give me a concrete example?
Sure, a very common one. Take small savings schemes in a post office, like the National Savings Certificate or a post office savings account. The terms of offer for those schemes explicitly exclude NRIs.
Oh, really? I assumed anyone could walk into a post office and open an account.
Not for those specific investment schemes. If you are a non-resident, you simply cannot open one. That is a term of offer. Another example, pension plans. They often have an upper age entry limit. You might see a term that says entry age not beyond 60 years. If you are 61, the terms of offer bar you from entry.
So it also sets the minimum and maximum amounts?
Yes, the floor and the ceiling. It will say minimum investment is 5,000 rupees and maybe maximum investment is 1.5 lakhs per financial year. Like in a PPF, you have to operate within those boundaries.
Right. So you have to match the profile in the document. Now let's talk about the big regulatory requirement in section 17.1.4, the PAN card.
The permanent account number. In the Indian financial landscape, the PAN is the golden key. It's the one number that links all your financial activities for the income tax department.
The text says it's mandatory for almost everything. I want to drill down on the specific numbers here because I see a lot of 50,000 rupee figures popping up. This seems important.
Very important. Let's play the rule of 50K game. The regulator has basically decided that 50,000 rupees is the threshold where they want to start tracking you seriously.
Okay, let's list them out. Where do I absolutely need a PAN?
Okay. If you open a bank fixed deposit, an FD, for an amount exceeding 50,000 rupees, mandatory PAN.
Check.
If you pay a life insurance premium in a single financial year exceeding 50,000 rupees, mandatory PAN.
Check.
If you are depositing cash into the National Pension System, or NPS, and the amount is over 50,000 rupees, mandatory PAN.
Okay, I'm sensing a very clear pattern here, but are there exceptions or different limits?
Yes, and this is where the exam gets you. It loves the exceptions. Look at the post office again. For a post office savings account or a simple deposit, the limit is indeed 50,000 rupees. But for other post office schemes, the text says the threshold is if the balance exceeds 10 lakhs.
Whoa, that's a huge jump. 50,000 versus 10 lakhs.
Correct. So you have to read the question very carefully. Is it a generic deposit or a specific scheme? Is it a single transaction or the total balance? Also look at the NPS Tier 2 account.
Tier 2. That's the withdrawable investment account, the one that works more like a mutual fund, right?
Exactly. For a Tier 2 NPS account, PAN is mandatory, always. There is no 50,000 rupee threshold. The moment you decide to open a Tier 2 account, you need a PAN, period.
That is a vital distinction. I might have some wiggle room on small cash deposits, but Tier 2 is hard-coded for PAN from Ruby 1.
Precisely.
Now, once we have the PAN, we fill out the application form. Section 17.1.5 breaks down the mandatory investor information. Name, address, bank account. It feels basic, but I bet there are nuances here that can get an application rejected.
Oh, there are operational landmines everywhere. Let's look at the name field. It sounds silly, but the name on the application must match the proof of identity exactly, character for character. If your passport says Robert J. Smith and you write Bob Smith, the application will likely be rejected.
Okay, so no nicknames. What about joint holders? This seems to get complicated.
This is a classic comparative question for the exam. The rules differ based on the product you're buying.
Okay, let's say I'm buying a mutual fund or some corporate bonds. How many people can be on the account?
For mutual funds and bonds, the maximum is 3. 1 primary holder and up to 2 joint holders, so 3 in total.
Max 3 for funds and bonds. Got it. Now, what if I walk into a bank to open a fixed deposit or the senior citizen savings scheme?
For Bank FD or the SCSS, the maximum is usually 2 holders, a primary and 1 joint holder.
That is a bit arbitrary. But okay, max 3 for funds, max 2 for banks. So what about the NPS, the pension system?
0 joint holders. The NPS is strictly an individual pension account. You can have a nominee, of course, to receive the funds if you pass away, but you cannot have a joint holder who co-owns the account while you're alive.
That is a crucial difference. I can see a match the column question on the exam right now, linking products to the number of holders.
It's a very common question format. And while we are on joint holders, we have to talk about the tax implication. This is huge. In the eyes of the income tax department, who owns the money in a joint account?
I would assume it's shared? Maybe 50-50?
Operationally, no. That's not all tax liability and all income, like dividends or interest, accrue to the first holder. The person whose name is first on the application form is considered the primary owner for tax purposes.
So the second and third holders are essentially invisible to the taxman.
Unless you can prove specifically otherwise in a tax audit with a separate declaration, the system defaults to the first holder. This is why the order of names is a genuine financial planning decision. If you're in a high tax bracket and your spouse is in a low one, you generally don't want to be the first holder on a fixed deposit that generates a lot of interest income.
That is a great practical tip. So the bank account details on the form, do they also have to belong to the first holder?
Yes, absolutely. The bank account for debits and credits must belong to the first holder. You generally cannot use the second holder's bank account to fund the investment or receive the redemption. It triggers third-party funding rules, which we'll get to later.
Okay. Moving to section 17.1.6, the investor folio. I always visualize this as an old-school manila folder with my name on it in a dusty filing cabinet.
That's exactly what it is, just in the digital form. A folio is your master customer ID with a specific asset management company or registrar.
And why do we need it? What's the point?
Convenience. Imagine if every time you wanted to buy more units of a fund, you had to fill out your name, address, PAN, bank details, and nomination all over again. It would be a nightmare. The folio stores all that static information. Once you have a folio number, you can just use a simple transaction slip. You quote the number, say, buy 10,000 rupees more of X fund, and sign. The system knows the rest.
And one folio can hold multiple funds from the same fund house.
Yes. You can have an equity fund, a debt fund, and a gold fund, all sitting inside one folio number. It gives you a consolidated view of your relationship with that one fund house.
Right. Okay, let's move to the heavyweight section. Section 17.2, PAN and KYC process. We mentioned the PAN limits, but let's talk about the card itself in the process.
The PAN is issued by the Income Tax Department. You apply for it using Form 49A. Remember that form number?
Form 49A, noted.
And the specific rule that lists all those transactions we discussed, the 50,000 rupee limits, the 10 lakh balance for post office schemes, is Rule 114B of the income tax rules. Flag that as well.
Okay, Form 49A to get the card. Rule 114B tells you when you have to show the card. But is there any way to invest without a PAN? The text mentions a micro rule, which sounds like an exception.
There is a very narrow exemption. We call it micro investments. This applies specifically to mutual funds. If your aggregate investment is less than 50,000 rupees per financial year, per fund house, you might be exempt from submitting a PAN.
Per fund house. So theoretically, I could invest 40,000 in HDFC mutual fund and another 40,000 in SBI mutual fund in the same year, all without a PAN.
Theoretically, yes, because you are below the 50,000 limit with each fund house. But you still need to be KYC compliant. You can't be anonymous. They call it PAN exempt KYC, and you get a special number called a PKRN. You still have to prove who you are with other official documents.
Is this available to everyone? Can an NRI use this?
No. This is a very important restriction. This is strictly for resident individuals.
Yeah.
HUS cannot use this. NRIs cannot use this. It's really designed for small savers, maybe in rural areas, or people just entering the formal financial system. Also, another exemption is the BSBDA, the Basic Savings Bank Deposit Account. That's also exempt from PAN requirements.
Got it. Now, let's look at the machinery of KYC itself in Section 17.2.2. The legal backing here is the PMLA.
The Prevention of Money Laundering Act, 2002. That is the parent law. It dictates that all financial institutions must verify the identity and address of their clients to prevent financial crimes.
The old way of doing this was terrible. You'd go to a broker, do KYC, then you'd go to a mutual fund, and you'd have to do the entire KYC process all over again with the same document.
It was incredibly redundant and wasteful. That's why the KRA was introduced, the KYC Registration Agency. This was a massive structural improvement for the industry.
How does the KRA system actually work?
Think of the KRA as a central shared database for KYC records. There are a few of them, CDL and DML, CAMS, and so on. When you do your KYC with any SEBI-registered intermediary, like a broker, they scan your documents and upload your data to the KRA system. Then your KYC status becomes KRA compliant. So if you go to a different broker or a fund house next week, they just punch in your PAN number. Their system queries the KRA, is this person compliant? The KRA says yes, and electronically downloads your verified data. You don't have to submit the papers again.
Do KYC once, use everywhere?
Within the securities market, yes. That's the principle. But now we have the next evolution, which is e-KYC. This is the Aadhaar-based route.
This is the one where you just enter your Aadhaar number and you get an OTP on your phone.
Yes, that's the most common form. But there's a catch, a very important one for the exam. If you use the OTP-based e-KYC, where there is no physical meeting and no biometrics involved, your investment is capped. You can only invest up to 50,000 rupees per fund house per financial year.
So the convenience of the OTP comes with a limit, the same 50,000 rupee number again.
Exactly. If you want to invest more than that, you need to upgrade your KYC by doing a full biometric verification, or what's called an in-person verification, or IPV.
Speaking of in-person verification, the text discusses video IPV or VIPV. This blew up during the pandemic when nobody could meet face-to-face.
It did. And the regulations around it are fascinatingly specific.
Yeah.
Can't just be a simple video call. It has to be a live, real-time video interaction. The application being used must capture your live location via geotagging.
To prove you were actually in India at that moment.
Or at least to prove you are where you say you are. You cannot cover your face. You must be in good lighting. And the official doing the verification has to ask randomized questions.
Like, what is the capital of Peru?
More likely questions to ensure you are responsive and not a pre-recorded video. What is your date of birth? Please hold up your PAN card to the camera and read the number. They need to ensure liveness. and that you aren't being coerced by someone off camera, and the entire video must be stored securely and be tamper-proof.
And now there's something that sits above all the KRAs, a new giant called CKYCR.
The Centralized KYC Registration Agency. This is the super registry.
What makes it so super? What's different from a normal KRA?
The scope. A KRA was mostly for SEBI-regulated entities, so stocks and mutual funds. CKYCR is cross-sector. It covers SEBI, RBI for banks, IRDI for insurance, and PFRDA for pensions. The ultimate goal is one single KYC for your entire financial life.
So I do it once, and my bank, my broker, and my insurance company all have access to it.
That's the vision. One KYC to rule them all.
And who manages this beast?
CERSAI. The Central Registry of Securitization and Asset Reconstruction and Security Interests of India.
That is quite an acronym.
It is. But for the exam, you just need to know that CERSAI runs the CKYCR and that this started operations back in 2016.
Okay, let's assume we are fully onboarded. We have the PAN, we are KRA or CKYCR compliant. Now we want to buy some shares. But we don't get those beautiful paper certificates anymore. We use a demat account. Section 17.3 covers dematerialisation.
DMAT is just the short form for the process of converting physical securities into electronic entries in a computer system. It's like moving from cash in your wallet to a number in your bank app. The value is the same, the form is different.
And the governing law here is the Depositories Act, 1996.
Correct. And the key players you need to know are the depositories in India, that's NSDL and CDSL. Think of them as the giant secure vaults where all the electronic securities are held.
And the depository participants, the DPs.
Those are your brokers or banks. They are the gatekeepers to the vault. You, as an investor, cannot talk to NSDL or CDSL directly. You have to go through a DP. They're your point of contact.
The text outlines a very specific workflow for dematerialization. I want to walk through this step by step because it visualizes the process really well. So, step 1. I find an old physical share certificate in my grandfather's drawer. What do I do?
First, you fill out a DRF, a dematerialization request form. You submit this form to your DP, your broker, along with the physical share certificates.
Okay, then what does the broker do?
Step 2. The DP verifies your details and issues you a DRN, a dematerialization request number. This is your tracking ticket for the whole process.
Step 3. This is where it gets interesting.
This is the visceral part. The DP checks the certificates to make sure they're genuine, and then they physically punch holes in them.
They punch holes in my valuable shares.
Yes. They literally mutilate the certificate. They will stamp "surrendered for dematerialization" right across the face of it. This is a critical step to ensure those physical certificates can never be sold or used again. It kills the paper to give birth to the electronic record.
That makes perfect sense. It prevents double spending.
Exactly. Step 4. The DP sends an electronic request to the issuer of the shares or their registrar and transfer agent, the R&T agent. At the same time, they physically courier the mutilated certificates to the R&T agent.
So the paper travels one last time, its final journey.
Its final journey. Step 5. The registrar receives the electronic request and the physical papers. They verify everything. Are the signatures on the certificate real? Are these certificates on a stop transfer list for some reason? Are they fakes?
And if it's all good?
Step 6. The registrar updates their register of members, which is the master list of shareholders, to show that these shares are now held by the depository, NSDL or CDSL, on your behalf. They then confirm this with the depository. And finally, step 7, the depository credits the equivalent number of shares into your electronic demat account.
It's a complete loop. Investor to DP, DP to registrar, registrar to depository, and depository back to the investor's account.
Precisely. That's the chain of custody.
Now, can we go backwards? Say I want that beautiful paper certificate back to frame on my wall. Can I do that?
You can. The process is called re-materialisation. You submit an RRF, a re-materialization request form.
Why would anyone do that in this day and age?
Honestly, very, very few people do. Maybe for a specific legal dispute where a physical document is needed, or maybe, like you said, you just want the look of the certificate. But it's cumbersome. Your electronic balance of shares gets blocked. The issuer's R&T agent has to print a brand new physical certificate with a new certificate number and mail it to you. It's an archaic process.
Okay, moving to section 17.4. Power of attorney or POA. This sounds like a very serious legal document.
It is a powerful legal instrument. You are legally authorizing someone else to operate your account on your behalf. In the investment world, there are two flavors you absolutely need to know: general POA and specific limited POA.
General POA sounds like the God mode version, right?
Yes, that's a good way to put it. A general POA gives the attorney, the person you give the power to, the right to do almost anything: sell your house, file your taxes, sign contracts in your name. It is extremely risky to give this to a broker. You generally should never do it.
So what do we use for our online trading accounts then?
You use a specific limited POA. This is what you most likely signed when you opened your online brokerage account, maybe without even realizing its full name. It is restricted to very specific acts.
Like what, for example?
Usually, it just authorizes the broker to debit shares from your Demat account only for the purpose of delivering them to the exchange when you have sold them.
Ah, that explains the mechanism. Because when I sell on my app, I don't physically sign a delivery instruction slip for the shares to leave my account.
Exactly. The limited POA allows the broker to automate that settlement process. Without it, you would have to physically sign a slip for every single sale you make, which would make online trading impossible.
Are there any restrictions on who can grant a POA?
Yes, two very important ones to remember. First, minors cannot grant a power of attorney.
Because they lack the legal capacity to enter into a contract?
Correct. And second, a POA holder cannot make nominations on behalf of the investor.
Yeah.
I can trade for you with a POA, but I can't decide who inherits your money. That right always stays with the account holder.
Okay, brace yourself. Section 17.5, account opening for non-residents, or NRIs. This feels like the heaviest, most complex section in the entire chapter.
It is the beast of the chapter, for sure. It involves a mix of the Income Tax Act, FEMA rules, and specific banking regulations. This is where a lot of people get confused.
Let's start with the most basic definition. Who exactly is an NRI?
It actually depends on which law you're looking at. The Income Tax Act uses a residency test based on the number of days you've spent in India.
The famous 182-day rule.
That's the primary one. If you are physically present in India for 182 days or more in the previous financial year, you are a resident for tax purposes.
So if I'm here for 181 days, I automatically become an NRI.
Not necessarily. There's a secondary trap. It's the 60 days plus 365 days rule. If you are in India for 60 days in the previous year, and you've been in India for a total of 365 days in the last 4 years combined, you're also considered a resident.
Wow, okay. So you have to fail both of those tests to be classified as an NRI for tax purposes. That's tricky.
It is very tricky. Now, once the system determines you are an NRI, the Foreign Exchange Management Act, or FEMA, kicks in. FEMA says you cannot hold a regular resident savings account. You need special buckets for your money.
And these are the infamous NRE and NRO accounts. I always get these two mixed up. Can you break them down simply?
Let's try. Think of it this way. Bucket A is for your foreign money. Bucket B is for your local Indian money.
Okay, foreign versus local. I can work with that.
NRE stands for non-resident external. This is bucket A. This is for money you earn abroad. Your salary in dollars, pounds, dirhams that you send to India. The key feature, and the most important one, is that it is freely repatriable.
Meaning I can take the money back out of India whenever I want.
Anytime. No questions asked. You can move it back to your account in New York or London without asking anyone for permission. It's considered your foreign money, just parked in India.
Okay, so NRE is for repatriable foreign income. What about NRO?
NRO stands for non-resident ordinary. This is bucket B. This is for money you earn in India while you're an NRI. Maybe you have an apartment in Bangalore that's collecting rent. Maybe you get dividends from shares you own in Tata Motors. That money goes into the NRO account.
And is that repatriable? Can I take that money out?
Generally, it is restricted. You can move up to $1 million per financial year out of an NRO account, but it's a process. You need to submit forms like 15CA and 15CB and get certificates from a chartered accountant. It's not freely repatriable like the NRE account.
Right. And there's a third one, FCNR. What's that?
FCNR stands for Foreign Currency Non-Resident. This is essentially a fixed deposit, but you hold it in the foreign currency, so you're not converting your dollars into rupees. You hold US dollars or British pounds as a fixed deposit in an Indian bank.
Why would I do that instead of an NRE fixed deposit?
To avoid currency risk.
Yeah.
If you convert your dollars to rupees to make an FD, and the rupee crashes against the dollar over the next year, you lose a lot of value when you convert it back. With an FCNR account, your money stays in dollars. You're protected from rupee depreciation.
That's smart. Now, can an NRI just start buying stocks through these NRE or NRO accounts?
Not directly for secondary market trading. For that, they need a special account called a PIS account portfolio investment scheme. This is a specific designation given to either their NRE or NRO bank account by the bank.
And what's the rule there?
An NRI can only have one PIS account in India. Just one. And they must keep their PIS funds, which are for trading, separate from their non-PIS funds, which might be for savings or other investments like mutual funds. The bank monitors this account very strictly to report all transactions to the RBI.
And are there limits on how much of a company an NRI can own?
Yes, and this is a huge exam flag. An individual NRI can own a maximum of 5% of a company's paid-up capital.
5% for one person. What about all NRIs combined?
All NRIs put together cannot own more than 10% of a company. This is the aggregate limit.
Is that 10% limit hard-coded, or can it be changed?
It can't be changed. The company can pass a special resolution in its general meeting to raise this aggregate NRI limit up to 24%, but the individual limit of 5% always stays.
And what about their trading style? Can they day trade like a resident?
Absolutely not. NRIs are banned from intraday trading. They cannot short sell. They can only do delivery-based transactions. If they buy a share, they must pay the full amount and take delivery into their demat account. If they sell, they must have the shares in their account first. No speculation is allowed.
One last detail on NRIs. The text mentions mariners. What's special about them?
Mariners, or merchant navy crew, are a special category because they are often at sea for months at a time, and their residency status can be complex. To prove their status for account opening, they need to submit a copy of their CDC, their Continuous Discharge Certificate. That's their official passport for the sea.
CDC. Got it. Okay, that was a lot. Let's move on to section 17.6. Maintenance of investments. This covers the life cycle events after the account is open. Let's start with a simple one. Moving house, a change of address.
This is where the KRA system we talked about really shines again. You don't need to write to every single mutual fund and broker. You submit a change of address form to any single KRA registered intermediary. They update it in the central KRA system, and legally, that data should flow to all your other linked intermediaries.
So it's a one-and-done process.
It should be, yes. Now, what about a bigger change? A change in status. Say, I am a resident, and I get a job in London. I officially become an NRI. What do I have to do? This is critical. You must inform your bank and your broker immediately. It is actually a violation of FEMA rules to continue holding a resident savings account if you are a non-resident.
A violation? That sounds serious.
It is very serious. Operationally, you have to convert your resident savings account into an NRO account. You need to open a new NRE account for your foreign earnings. And for your demat account, you need to open a new non-resident demat account and transfer all your existing shares into it. You cannot continue to trade from your old resident demat account.
That is a massive operational pivot. It's not just a small change of status. And what about coming back? An NRI returning to India for good?
It's the same drill in reverse. You inform the bank, you close the NRE and FCNR accounts, or you convert them to resident rupee accounts. Your NRO account becomes a regular savings account. Your non-resident demat account status is changed to resident.
Okay. Next topic in maintenance. Marking a lien. This is about pledging my shares for a loan, right?
Correct. Suppose you need a loan, but you don't want to sell your Infosys shares that you've held for years. You can pledge them as collateral to the bank. This process is called marking a lien.
How does it look to me as an investor in my demat account?
You'll write to your DP to mark the lien. A lock is placed on those specific shares. You can still see them in your account. They're still yours, but you cannot sell them. They are effectively frozen in favor of the lender, who is called the pledgee.
And who can unlock them?
Only the lender. Once you repay the loan, the lender instructs the DP to remove the lien. Or, if you default on the loan, the lender can invoke the pledge and sell the shares to recover their money.
Right. Now we have to talk about the inevitable. Section 17.6.5, transmission. This sounds like a mechanical term, but it's actually about what happens when an investor dies.
Yes. Transmission is the specific legal term for the transfer of assets due to an operation of law, which is usually death. It is distinct from a transfer, which is a voluntary sale between two living people.
Okay, so who gets the shares? This must be a common issue.
It is, and it depends entirely on the holding pattern and whether a nomination was made. Let's take the scenarios.
Joint holding. This is the simplest. If holder A and holder B own shares jointly and holder A dies, the shares legally and automatically pass to the surviving holder B.
What does holder B need to do?
The survivor just needs to submit the death certificate of holder A and some simple forms to the DP or the fund house. The deceased's name is removed and the survivor becomes the sole owner.
That seems very easy. Okay, scenario 2. Single holding with a nominee.
This is where people often get confused. The shares are transmitted to the nominee, but, and this is a massive legal but, the nominee is legally a trustee or a custodian.
A trustee, not the owner.
Correct. The nominee receives the assets to hold them in trust for the ultimate legal heirs, who would be determined by a will or by succession law. The nominee is not necessarily the owner unless they also happen to be the legal heir.
So the fundhouse gives the money to the nominee, but the real heirs could technically sue the nominee to get that money.
Exactly. For the mutual fund or the bank, their liability is over once they pay the nominee. They wash their hands of any family dispute. The nominee is just a caretaker until the rightful owner is established.
Okay, that's a crucial point. Now, the worst case. Scenario 3. Single holding, no nominee, no will.
This is the operational nightmare. The family needs to go to court to get legal succession documents. This could be a succession certificate or a probate of a will if one is found later, or letters of administration. This takes a lot of time, money, and lawyers.
The text mentions some monetary limits for a simplified process to avoid going to court for smaller amounts.
Yes, and you must flag these numbers for the exam. If the total value of the securities is less than 5 lakh rupees for physical shares or less than 15 lakh rupees for demat shares, the claimant can often use a simplified process.
15 lakhs for demat. That's the key threshold.
Yes. If the holding is under that, you can usually get by with submitting an indemnity bond, an affidavit, and a no objection certificate from other potential heirs. But if the value is above 15 lakhs, you will almost certainly have to go to court.
It also mentions that nomination is now mandatory for new folios opened since October 2022.
Yes, this is a recent and important change. If you open a new single holding account, you must either nominate someone or sign a specific declaration that you are consciously opting not to nominate. You can't just leave that section blank anymore.
And how many nominees can I have?
You can have up to 3 nominees, and you can specify the percentage of the holding that each nominee will receive.
Moving on to section 17.7, special investor categories minors. We touched on this, but let's drill down. A minor can invest, but they can't sign a contract. How does that work?
Right. So the account is always opened as by guardian on behalf of minor. The guardian, who must be a parent or a court-appointed legal guardian, operates the account. All documents are signed by the guardian.
And the payment for investments. Where does the money come from?
This is strictly monitored. The payment must come from the minor's own bank account, if they have one, or from the guardian's verified bank account. You cannot have a random uncle or grandparent paying for the investment.
Now here is the really interesting operational event. Minor turned major, or MAM. The kid turns 18. What happens on their birthday?
A freeze. The system knows the minor's date of birth. On the exact day the minor turns 18, all transactions in the account are automatically stopped. No purchases, no redemptions, no switches.
Everything just stops cold.
Everything. The account is frozen until the person, who is now a major, completes a new set of formalities. They must submit their own new KYC documents, their new PAN card details, and their own bank account details. The guardian is then completely removed from the account, and the major now operates it independently.
What about systematic investments? If the dad set up an SIP for his son's education fund?
The SIPs stop. SIPs, STPs, and SWPs are all suspended the moment the minor turns major. This is a very common exam question. What happens to an SIP when a minor turns major? The correct answer is, it stops executing until the new status is updated.
That is critical to remember. Okay, section 17.8. Payment instruments. We know about checks and demand drafts. Let's talk about the digital alphabet soup. MICR, IFSC, RTGS, NEFT.
Okay, quickly. MICR is the old 9-digit code on the bottom of checks. It stands for Magnetic Ink Character Recognition. It identifies the city, bank, and branch and was used for check clearing.
And IFSC.
That's the Indian Financial System Code. It's an 11-digit alphanumeric code that we use for all online transfers. It uniquely identifies a specific bank branch.
Now, what determines whether I use RTGS or NEFT for an online transfer?
It's all about the amount and the speed you need. RTGS stands for real-time gross settlement. The real-time part is key. It's for high-value transactions, and the minimum amount is 2 lakh rupees. It's processed instantly, one-to-one.
So RTGS is for big money, sent fast. What about NEFT?
NEFT is National Electronic Funds Transfer. The system works in batches, usually every half hour. There's no minimum amount. You can send 100 rupees via NEFT. It's for smaller, non-urgent transfers.
Okay. Now, section 17.8.3 brings up the prevention of money laundering again with the very important third-party rule.
Yes. The general overriding rule is the money for an investment must come from the investor's own bank account. If I am the first holder of the mutual fund folio, the check must be signed by me from my bank account.
So if my grandfather wants to be generous and invest 1 lakh rupees in a mutual fund in my name, and he writes the check from his account.
Generally, that application will be rejected by the fund house. Third-party payments are a major red flag for money laundering and are not allowed.
Are there any exceptions to this at all?
A few, very specific ones. Employers can invest on behalf of employees through payroll deductions. Custodians can pay on behalf of foreign portfolio investors. And for small investors, SEBI allows cash investments up to 50,000 rupees per year per mutual fund, but this is heavily monitored and very rarely used these days. But for the most part, Grandpa needs to gift you the money first into your account, and then you invest it from there.
Got it. Section 17.9 covers the paperwork for getting financial advice. If I hire a SEBI-registered investment advisor, an IA, what do I sign?
You must sign a formal agreement. And SEBI has mandated that this agreement must include a summary document called the MITC Most Important Terms and Conditions.
Like the summary box on a credit card statement that no one reads but should.
Exactly like that. It's designed to prevent the advisor from hiding unfavorable clauses in the fine print. The MITC must state clearly and upfront. The advisor cannot accept cash deposits. They cannot guarantee returns. They must disclose all their fees and conflicts of interest transparently.
And if I have a complaint against my broker or advisor, what's the process?
The hierarchy of grievance redressal is key to know.
Always contact the intermediary first. Go to the compliance officer of the broker or advisor.
If you aren't satisfied, you go online to SCORES, which is the SEBI complaints redress system.
If that also fails to resolve the issue, there is now the ODR, or Online Dispute Resolution Portal, which is a more formal arbitration process.
SCORES is the big one to remember for the exam. Finally, Section 17.10 talks about investing in mutual funds through stock exchange platforms. What is this about?
This refers to platforms like BSE Star MF and the NSE NMF2 platform.
Now, what's the idea here?
Traditionally, you bought shares through a stockbroker and mutual funds through a separate distributor or directly from the fund house. These platforms allow you to use your existing stockbroker's terminal and demat account to buy and sell mutual funds.
So I can see my HDFC bank shares and my HDFC mutual fund units on the same screen in the same statement.
Yes, that's the biggest benefit. It offers a single view of your entire portfolio. It also eliminates a lot of paperwork because it uses your existing broking and demat KYC. And crucially, when you buy, the money goes to the exchange's clearing corporation, not directly to the broker, which eliminates counterparty risk.
That wraps up the chronological run-through. That was a lot of plumbing, a lot of pipes and valves.
It was. But think about the story we just told. We started with who can invest. We got them through the door with KYC and PAN.
Yep.
We gave them a digital locker to hold their assets, the demat account. We looked at the special complex cases like NRIs and minors. We discussed how to pay for things with RTGS and NetFT. And we talked about what happens at the end of the road with transmission.
It really is the full life cycle of an investor. Born in KYC, you live in the demat system, and you get transmitted upon death.
A very poetic way to put it, yes.
So what's the final takeaway for the listener who's preparing for the exam or just wants to be a smarter investor?
Operations isn't just boring paperwork. It's the safety net for your money. If you mess up the first holder rule, you could mess up your taxes for years. If you ignore the nomination rule, you could leave a nightmare for your family. If you don't update your status from resident to NRI, you are technically breaking the law. Understanding this stuff ensures you or your clients never get your money stuck because of a simple, avoidable technicality.
That is a powerful thought. And here is a provocative question to leave you with. We've talked about video KYC, online dispute resolution, and electronic dematerialization. We are clearly moving to a completely faceless finance world. Does this incredible seamlessness reduce fraud because everything is digital and has a clear audit trail? Or does it make identity theft the new biggest risk, where a sophisticated scammer can steal your entire financial life just by cracking your biometric data or getting your OTP?
That is a very scary and very real thought to end on.
Something to mull over. Thank you for listening to this deep dive into the operational aspects of investment management. Good luck with the exam.
Keep learning.